Hey everybody, welcome back to the channel. We are back on another episode of the Daily Recap. Folks, this has been one of those days. If you are with me on the Market Open stream, you're probably with me for about 4 hours, and I didn't think much of today. It was Wednesday, middle of the week. I was like, all right, you know what? Let's get into the Market Open. Let's see what we got going on. Within about an hour, Bitcoin starts moving, Nvidia starts moving, Robinhood starts moving. I mean, we hit all-time highs on Bitcoin at 109. Robinhood was pushing 67. Nvidia was pushing 137. It just became a wild market open. It became a party. It legitimately was a party. If you were part of it, you were in a party. And then by 1 p.m., something happened in the credit markets, the bond markets in the United States. We're going to talk about that today, but that kind of made the party not as fun anymore. And stocks fell. The S&P fell 1.5% after hours. And yeah, that kind of made the market close less of a party. Still was a good day. Just had a little bit of a hiccup towards the end of the day, which might end up turning into a broader issue. And that's what the majority of this episode is going to focus on. On top of that, Palantir, $800 million contract extension. That's a big one. We will talk about that. We've got some OpenAI news in terms of what's happening with Apple. We got some other macro data. And then Bitcoin, as of when I'm recording this, we just hit 110,000. In the midst of all of that stuff that happened on the market close with the bond market that caused the S&P 500 to fall 1.5%, Nvidia to go from 137 to 131, Bitcoin is hitting all-time highs, just surpassed 110K. We got some things to talk about. Let's get into it. All right, let's start off with what happened in the bond markets today. So in the bond markets, you need people to buy bonds, right? You need people to bid for our bonds. Our bonds are how we fund the United States federal government. It's how basically pretty much every country in the world funds their government outside of taxes, right? You issue debt, people buy that debt, you pay interest on that debt. And the reason we get that debt up right now is because we pay the interest over years, and then we're able to do something with that money. And that's kind of how a country is able to finance all the ways that we need to finance our operations. The 20-year bond auction was today. And apparently that was happening around 12:30 p.m., 1 p.m. Eastern, basically right when I got off the market open. And it went okay, but not really good. Now, what do I mean by that? This is what happened to the 20-year bond. You're seeing it right now on the screen. It spiked up to 5.104%. Remember, when people sell bonds, yields go up. That is not a good thing. You want yields to stay down. That basically controls the cost of capital. And in order to get yields to come down, you have to buy bonds, or you have to have someone buy bonds, right? There has to be some type of demand, whether it's the Fed, whether it's different countries, banks, whatever it may be. People have to buy our bonds in order to get yields to come down. The biggest problem we've had over the past couple of months is that yields have been up. One easy way to get yields to come down is the Fed cuts interest rates across the board. That would easily get rates to come down. But Jay Powell's not doing that because he's afraid about inflation. So why did the US 20-year Treasury bond break 5.104%? Like that's the real question here, because breaking 5.104% is the issue, and it's kind of why the stock market immediately had a bit of a sell-off. And the reason for that is as follows. The Treasury auction demand softened, but it didn't collapse. And so reading here from Bloomberg, the 20-year Treasury refunding auction was mixed, though leaned toward the weak side despite its 5% coupon, which is kind of what created all the pain, seeing that 5% headline on the 20-year. The auction tailed by 1.2 bips, the largest at a refunding since November, so since basically 8-9 months. Indirect bidder participation rose to 69% of public issuance versus 63% in February, and the last three funding average of 67.8%. Direct bidders shied away versus their recent history, winning 14.1% of the sale versus 19.5% at the February refunding. Okay, sounds like some mumbo jumbo bond stuff. What does essentially that mean? It means that the reason we're getting a 5% handle is not because there was a lack of demand on our bonds. There were people willing to bid on our bonds. The problem is, again, when you sell bonds, yields go up, and there was some selling into the buying. It's almost like if you're buying a stock, right? And, let's say 1,000 people are buying a stock all at the same time. The stock should go up, right? Because there's a lot of buying pressure. But let's say 1,100 people are selling the stock. So you're going to get some momentum, but you have those extra 100 people that are selling as well, which in that case would get the stock to go down. It's an inverse relationship for bonds and their yields. In this case, the reason we got the 5% handle is because of the credit rating that we just got from Moody's, which obviously was not a good thing because, now the Moody's is saying, hey, the United States has a bad credit rating. I still think that is relatively not that important, right? Because like Moody's is not the end all be all, but nonetheless, the bond market, the credit market cares about that, which is why it was a headline Friday afternoon last week. That you had, and then you have a combination of long-term inflation expectations and tariff uncertainties. So although there were bidders that were willing to bid for that 20-year bond, it should have been at around 4.637%, and it ended up being at 5.1% because there were also people that were selling into all the momentum that came in to buy, which essentially meant it was a weak auction. It was not a horrible auction. It was not an auction to the point where it's like, oh my God, no one's willing to buy our debt. Like, can we get anyone in the world to buy US debt? Like, there were bidders to buy the debt. The problem is there were also sellers, and there were not more bidders than sellers in the particular context of how they bid for our bonds, which is what caused that 5% yield. And unfortunately, right now, we still have that 5% yield on the 20-year. On the 10-year, let's take a look at that right now. We're at 4.601, which also not good. Like just like we were at 4.1 2 weeks ago. We were at 4.8 in January. Now we're at 4.6. Now, again, people could be selling bonds in order to be able to buy stocks, right? People are saying, hey, let's get rid of bonds, and that could cause yields to go higher in order to buy stocks. But today, that kind of broke. And what I mean by it broke is not the system broke, but the system kind of realized, wait a second, if we aren't getting the adequate type of demand that is necessary in order for our auctions to be accurate, well, maybe we shouldn't be buying stocks. Maybe we should be kind of de-risking. Maybe we should be in cash. Maybe we should be going to gold. I mean, you have all these different assumptions that get made. And as a result, you had stocks that basically flipped during the middle of the day. Here's my take on this. So we got through the explanation of why that happened today. My take on this is very simple. Number one, I don't think selling your NVIDIA or your Palantir, your Robinhood or your Tesla just because bond yields are spiking ever makes sense. Like bond yields have spiked historically. They spiked in 2023. They spiked in 2011. They spiked in 2015. Like they're like the credit markets are going to be the credit markets. It's important to keep an eye on them. That does not mean you get rid of compounding assets and go straight into cash unless it's some cataclysmic tariff reciprocal nightmare, which we just went through a month and a half ago. So from that perspective, I don't think that's the case. And obviously that was a good time to buy the dip as well. I think any dip kind of gets eaten up because the institutions, as we talked about yesterday, are chasing this rally. A lot of them are still underweight equities. And as a result, I think they're going to be buying the dip if we do get any juicy dips across the board. That's my first point. My second point is that we really aren't getting juicy dips. The S&P 500 down 2%, NVIDIA from 137 to 132, okay. Palantir from 130 to 120, okay. Hood from 67 to 63, okay. Like, you know what I'm saying? Like, we are not really seeing Hood at 50, Palantir at 85, NVIDIA at 115. Like, we're not getting those types of dips. And so, you know, cry me a river about 2, 3, 4, 5, even 7% down when we're up 30 to 40% from the lows. Some of these stocks up almost 60 to 70% from the April lows, not just the lows of April 8th, but rather the lows of Liberation Day. And when you put that together, it's like, all right, it's really a nothing burger in terms of the momentum we saw today. Now, tomorrow, I'm going to be very interested on the market open to see if that momentum carries on to the negative side. And, you know, it could be. Futures are red right now. But whatever dip that is there, again, retail bought the Moody's dip on Monday to the tune of $4 billion. I think institutions might put their hat in the ring and say, all right, this is at least what we're waiting for. We don't know if we're going to get Rocket Lab at $18 again, but Rocket Lab at 21, we're willing to take a risk if it's down from 25. Rocket Lab right now is currently at 24.90. So that's my second take. My third take is that I think this can easily be solved, and there's two ways to easily solve this. Number one, Trump lowers the tariff rates on the reciprocal basis across every country. So instead of Zimbabwe, Thailand, and Vietnam paying 10%, they pay 7.5%. If you decrease the tariff rates, you get the Fed to have more of an incentive to say, hey, tariff inflation is not going to be that big of a deal. The Fed says, hey, we're more likely to cut rates. I don't think the Fed is going to cut rates in June, probably not even in July, but they need to get warmed up to the idea of cutting rates. The Fed is so scared of the tariff volatility and the tariff inflation that Trump could easily calm the markets, just like he did when he issued the 90-day pause, and then the S&P 500 went up 10% after going down 15%. It's not the craziest thing in the world to imagine that Trump gets involved here and does something that the credit markets would like. Number two is Besant. Besant easily could go on TV tomorrow. He issued a statement actually after hours with the Japanese prime minister and said, we have really started to begun our negotiations in a more strategic way. He was with the German chancellor this morning. If there is any world where Besant comes on TV and says, hey, we got deals coming, and just believe me, they're on the way, don't worry, the deals are coming pretty soon. If he can get the markets to believe in that as well, I think the credit markets can calm down and be like, okay, deals are coming. We're going to get tariff rates to be a little bit lower. We don't have to be as panicked and have this much certainty. We can actually buy the 20-year bond yield, the 10-year bond yield. We can buy Japan's 40-year bond yield, 30-year bond yield, because that also was kind of ruining the United States auctions, because given the Japan auctions failed the other day. And maybe that could also create some more momentum to not be that scared about what's going on in the credit market. So my TLDR is this is a nothing burger. For now, it could turn into a something burger. Right now, it's kind of a nothing burger. It's something we have to keep an eye on. I'm going to be watching the credit markets very closely. These yields going up is not good. So when I say nothing burger, I say it hasn't really affected stocks yet. Could it affect stocks? Of course. Do I think you get rid of an NVIDIA because you're afraid of what could happen to NVIDIA based on the credit markets? No. And so from that perspective, I don't think it's the biggest deal in the world, but it's something we absolutely have to keep an eye on. And I expect in the next 24 hours, especially if bond yields continue to rise, Trump or percent is going to have to say something, because I don't think they're going to allow the 30-year to be at 5%, the 20-year to be at 5%, and the 10-year to almost be at 5%. Hopefully, we get a statement soon from Trump or percent. Okay, next update is Palantir. We got a big update, big update from Palantir. Here we go, folks. For those that don't know the Maven contract for Palantir, it is a Department of Defense AI initiative for data fusion and target identification. Came out back in 2018. Google had a chance to get the project. Google said no because of whatever ideological reason they had for saying no. Palantir swooped in, took the contract. In 2024, we got a $450 million contract for Project Maven for about 5 years. Today, we got a $795 million contract extension on that $450 million. That means it is a $1.275 billion contract. This is the first 5-year billion-dollar contract for Palantir, the first billion-dollar contract Palantir has ever gotten in history, and it is with the Army in regards to the Maven Smart System project that they started working on back in 2018 and now have been able to get $1 billion in revenue on over the past 5 years. Look, it's encouraging, and the reason it's encouraging is because we just accelerated U.S. government growth at 45% in Q1. The reason the stock's not moving on this news, you might think, oh, $1 billion contract wires, because like the stock is, it's at $280 billion market cap. It's holding triple digits. Like the stock has done very well. So I think these are the types of contracts that you need in order to make the stock grow and mature and sort of marinate into its valuation. These are not like things that are going to necessarily move the stock in and of itself, because the stock has moved so much already. Having said that, the government business is growing, dude. $795 million over the next 4 years, in addition to the $480 million we got last year. I mean, I think the government revenue is just starting. We talked about a $218 million contract in the Space Systems Command and U.S. Space Force that we got on Monday for another data platform. Now this is another $1.275 billion contract for the Army. I just think government revenue is sticky. It's not going anywhere. Palantir probably is going to continue to make more of that government revenue, just given the nature of their platform and how effectively they're scaling. And if this administration wants to meaningfully architect the next generation of what it means to have software on the battlefield, and then software for the entire organization that is the government, right? The agencies that comprise of the government, I think Palantir is going to be a core winner there. So it is really nice to see this. Yesterday, we had the SAP partnership, largest technology company in Europe, 400,000 clients. A lot of you guys commented in my chat this morning that SAP sucks. I think we all kind of know that SAP sucks, but they have 400,000 customers. Palantir is not expanding in Europe. Palantir has less than 800 customers. Maybe SAP is saying, hey, we need to work with the cool kids on the block, and Palantir is saying, hey, we need to work with your distribution because we want to get 400,000 customers. You put those two together, that's very powerful on the commercial side. Commercial growth in the United States already growing so well, and then this government stuff continues to grow, continues to gain momentum. Palantir is the trusted source to be able to build these platforms for the U.S. government. It makes sense why we're getting these contracts, and I think the story is just getting started on the government side of the business. All right, next up, Bitcoin. What is happening in the world of Bitcoin? It's actually pretty simple. If this is just my opinion right here, I've been thinking about this all day. Why is Bitcoin hitting 110,000? Why is Bitcoin hitting new all-time highs, even if the credit markets are not collapsing, but definitely showing some weakness? This is the bull case for Bitcoin, right? Like the bull case for Bitcoin, all the orange pill stuff you hear from Michael Saylor and all these people, Lynn Aldrin, these sort of influencers that talk about the system being broken. The whole argument is that if we keep printing money forever, we keep debasing our currency, we keep devaluing fiat currencies, we keep raising the debt ceiling, we keep increasing the deficit, which at the end of the day hurts individual sovereignty, because individual sovereignty is connected to the ability to have economic mobility. Economic mobility is ruined if your purchasing power is ruined via inflation. Then do you have an asset that is a store of value that can hold that purchasing power, that can monetize and protect your sovereignty? It's a philosophical way of just saying, hey, if we keep printing money, people are going to want to not invest in that money, aka that debt. And that ends up being Bitcoin. I got a video from Jack Mallers, someone who's an OG in the Bitcoin community, saw it this morning, thought it's a good video to share. Here's 2 minutes, a little bit of dramatic music in there, explaining why people might be buying Bitcoin.
I expect China to buy gold and Bitcoin before they buy the 10-year. The deal was, we'll run a trade deficit as the United States of America. We will be the world reserve currency. You guys have to buy our treasuries, lend us money in return. Well, all of a sudden, these long duration instruments, they weren't preserving purchasing power because real rates negative. Meaning, yes, you're getting some yield by owning the 10-year, but inflation of the dollar losing purchasing power isn't compensating you. Your purchasing power is being lost. And China is like, screw it. I'm just going to buy Facebook. I'm just going to buy Amazon. I'm just going to buy Google. I'm just going to buy Nvidia. I'm just going to buy Apple. I'm just going to buy scarce real estate in the US. And it's like, well, that sucks because now we're allowing you to have this giant trade surplus and you just own all the like dope shit in America and we get screwed and there's a giant wealth gap in our country. There's no middle class. We can't produce anything. And so the deal is if you want to buy treasuries with no tax, you can go for it. But Besant is admitting their real rate's negative. So if you're China and you're saying, okay, the US doesn't want me buying their stocks, doesn't want me buying their real estate, doesn't want me buying their farmland, I can't buy any US assets without paying an enormous tax. And if I buy the 10-year, the Treasury Secretary is literally telling me real rates are going to be negative. So what should I buy? And then the US is out saying, by the way, we're auditing Fort Knox and we have a strategic Bitcoin reserve. I actually think the fact that the United States established a strategic Bitcoin reserve is unbelievable given the way they're re-architecting global capital flows. They're not literally saying this, but they're effectively saying, you got to buy gold, you got to buy Bitcoin.
That's why I think Bitcoin's higher. It's kind of simple. That's why I think Bitcoin is higher. Now, obviously, sailors have been buying. The ETFs have been doing very well, 6.5 billion in the past month. I think 50 billion overall in custody. I don't think this is retail. I don't think this is Robinhood, Coinbase. I think this is more institutional exposure coming into the name. And this cycle has shown us that either you think Bitcoin is the most risk-on asset and we can't be in a bear market because people are so risk-on that Bitcoin is exemplifying how risky the markets still are, right? And that like this is the time to get more exposure and not get less exposure. Or Bitcoin is actually becoming a counter-cyclical hedge against money printing. And it's not about risk on, risk off. It's just, hey, this is the asset that is going to win because everyone's printing money in the United States, Republicans or Democrats. Here's a picture right here also that explains how bad our situation is in regards to the revenue we take in, the debt we issue, the deficit we have, and the fact that no administration has been able to solve it. If no administration will ever solve it, then people are going to be looking for a new solution. And that solution might just end up being Bitcoin. All right, last topic of the day, OpenAI. This was big news. OpenAI acquired a company for $6.5 billion. This was Johnny Ive's company. Johnny Ive was the former director of design at Apple. He designed the iPad, the iPhone, the MacBook, the AirPod, and the watches, the Apple Watches. He left 5 years ago to start his own product company, and he's been obsessed with this idea of like, hey, how can we build an AI native product that is not the phone? You would think Apple would be creating an AI native product or integrating AI into the phone, but Apple's been late to the party. OpenAI, Sam Altman said, hey, we'll buy you up for $6.5 billion. There have been rumors for the past 2 years that these guys have been working together to be able to build some type of new device. It looks like we will be getting a new device pretty soon. OpenAI, almost 1 billion users, ChatGPT, the biggest AI product in the world. If they build the hardware on top of the software that is already miles better than a lot of other platforms that are out there in the world when it comes to LLMs, this thing can get really exciting for OpenAI. Apple was down 2% on the news today because the market is thinking that, hey, if Apple is left behind, then that's obviously not going to be good for Apple. So last thing I want to share on the show today is a 2-minute clip of Sam Altman and Johnny Ive talking about the future of what AI hardware looks like. Thank you all for listening and watching. It has been an absolutely wild day. But OpenAI is showing us the future is bright. Technology is here. There's a lot more S-curves coming. And as a result, investors that are investing in tech, regardless of what's going on in the bond market, I think are going to do well over the next decade. Thank you, everybody, for watching.
2 years ago, John and I started talking about what the future of AI and new kinds of computers was going to look like. I was running OpenAI. Johnny's running a design firm called LoveFrom that had established itself as really the, I think, densest collection of talent that I've ever heard of in one place and probably has ever existed in the world. And it became very quickly apparent to both of us that we needed a third company.
A year ago, I founded IO with Scott Cannon, Evans Hankey and Tang Tan, who are the most extraordinary engineers. They have built a team of remarkable subject matter experts that range from hardware and software engineering, physicists, researchers, product manufacturing experts. And so I/O is merging with OpenAI.
Formed with the mission of figuring out how to create a family of devices that would let people use AI to create all sorts of wonderful things.
The first one we've been working on, I think, has just completely captured our imagination.
You know, Johnny called one day and said, "This is the best work our team has ever done."
Yeah.
I mean, Johnny did the iPhone. Johnny did the MacBook Pro. I mean, these are like the defining ways people use technology. It's hard to beat those things. Those are really wonderful. Johnny recently gave me one of the prototypes of the device for the first time to take home, and I've been able to live with it. And I think it is the coolest piece of technology that the world will have ever seen.
The products that we're using to deliver and connect us to unimaginable technology, they're decades old.
Yeah.
And so it's just common sense to at least think, surely there's something beyond these legacy products.
We have like magic intelligence in the cloud. If I wanted to ask ChatGPT something right now about something we had talked about earlier, think about what would happen. I would like reach down, I would get out my laptop, I'd open it up, I'd launch a web browser, I'd start typing, and I'd have to like explain that thing, and I would hit enter, and I would wait, and I would get a response. And that is at the limit of what the current tool of a laptop can do. But I think this technology deserves something much better.